All right, we got some earnings still to get into and some consumer insights from the travel space. Tom White is here with me in studio looking at the options, and Ed Butowsky is joining us from Chapwood Investments to talk some Carnival and more. Shares down 4.5%. Managing partner at Chapwood, Ed, good to see you this morning.
Good to see you too. Thanks for having me.
Cruise lines were like impenetrable throughout last year, it seemed, from all the pre-bookings, but stock's down 4% this morning. What do you think?
I'm shocked that it's down. I mean, they absolutely knocked it out of the park in terms of everything that they did earnings-wise. And this, to me, is a buy stock right now. You need to own the stock because people who get off cruise ships immediately are looking to rebook. It's almost like a vice. and it's amazing.
That's great. I've never heard it described that way.
Yeah, but people are crazy about it. We just booked a cruise, my wife and I, for this summer, and we're already looking at another.
Where are you going?
We're going to Budapest and then up to Passau.
Wow.
Yeah, but we're not doing it on Carnival, but Carnival, Royal Caribbean, all of these are truly addicting, and they're doing a magnificent job. And the CFO at Carnival deserves the award for the greatest CFO because they went through the worst situation. The pandemic just destroyed their business. It went from a really solid business to nothing. And then they restarted it. They sold ships, and they did a fantastic job. And now they're on their way to a glorification. It's a fantastic story if you really looked into everything about Carnival Cruise Lines.
No, really well said. And I love that you know your stuff because it's been a fascinating group as someone who's never been on a cruise. I thought that COVID was going to be like this, major or rethink of the entire thing. And in retrospect, something like the opposite happened these last couple of years. Tom, to hear Ed describe it as a vice, I think that's a pretty smart way to think about it, actually, because there is like a repeat nature to it.
And to his point,
people book before they leave the cruise. They have things set up on those cruises. You can rebook.
Some of the numbers we've seen from these companies last year.
Yeah, bookings are over 100%. Return rates are above 90, I believe. Yeah,
because they're affordable too. There's a range, right? You can go super luxe if you want, right? But you can also go discount in a big way too.
Carnival is right there in that alley of discount.
Right.
But that's the affordability issue also. And they're paying down debt. I think that's really key here because they accumulated a lot of debt. They got the worst balance sheet out of maybe the three top cruise lines that Carnival does. But they're ahead of plans as far as debt repayment.
Okay. Do the options, was there a surprise in this? I mean, the move is not massive, but was there any skew in either direction?
Not really. Okay. No. I mean, there's always people taking cheap shots in these cruise lines, especially Carnival because it's such a low price stock, around $20 a share. So, and with that in context, now we've got that vol crush, even though the stock's down. Vols crush post earnings, of course. So I looked at a stock replacement type strategy.
If bullish, right?
If you're listening to Ed, you want to give yourself maybe a little bit of duration, a bullish call because there's not a lot of extrinsic option premium here to maybe sell something against something you buy. So I looked at a stock replacement, deep in the money call, out in the June cycle, buying the 17 strike call. You're going to pay roughly about a $3.80 debit for it. So there's going to be your risk, $380 per call that you purchase on this one. Takes your break even on this one up to $20.80 over the next 3 months, 91 days. That's only about 4% above the current share price. So you don't need a monster move. You're giving yourself some duration for it to recover, kind of settle down. Maybe the market bounces back also, which might help this stock. But stock replacement. Delta on this, a call that you're buying close to 80. So it reacts almost exactly like the stock does. So deep in the money, stock replacement type call purchase. Still risk defined. You know exactly what you're risking on this one as opposed to buying the stock. It doesn't pay a dividend.
All right, fair enough. Sounds like a decent way to do it. Get some long exposure. What do you think, Ed?
I didn't even think about doing that, but now I'm probably going to do that.
Boom! There it is.
Exactly what I need to do. Buying stock itself is one thing, but using a little bit of leverage is much smarter, especially with the global macro conditions that are favorable for cruise lines, especially Carnival.
You think stock-specific trades, or if you like the group, to buy them all, or do you just generally kind of think they all go in the same direction? Because some of these have departed from each other in the past. They kind of reconnected, but for a while there, it was kind of RCL out on its own. To some extent, still, Norwegian's down in the last year.
Yeah, maybe I have a mental problem, but I focus in just on specifically Carnival Cruise Line.
Okay.
I don't look at the other ones.
It's easier to figure out, I think. Yeah, Norwegian's a little more complicated with all the, well, I guess Tom's point, Carnival on the lower quality in terms of the debt load. It doesn't bother you?
No, it doesn't at all, because I think they're doing a miraculous job of handling it. Again, their CFO deserves an award for the champion CFO of the decade.
I love it. All right, thanks, Ed. Appreciate your thoughts, sir.
Thank you.
Enjoy the cruise. If we don't see you before then.
Yeah.
Bon voyage. Mr. Butowsky. Okay, Tom, we got one more trade in RCL, which is the big winner. I do kind of like Ed's point about, even though CCL's underperformed RCL, from like an understanding of their business, I think it's kind of the most straightforward, but RCL's the winner, so give me a trade there.
Yeah, it's pulled back, bear market territory from those all-time highs that we saw in January. Stock's down about 24% from those levels, so it gives you some opportunities. I think one of the key things when I looked at this stock is it has not been below its 200-day simple moving average for a year and a half, and it's getting close to it because the 200-day moving average is right around the $200 level as far as stock price goes. So I did something a little bit more conservative. This is a higher price stock. If the sector continues to fall, I want to stay risk-defined. I'm looking at selling something out in the April monthly cycle. So expires on the 17th. They report earnings on the 24th, so you avoid that event risk here, and with the expectations that, hey, it's going to remain above a specific strike over the next 27 days until April expiration. So looked at selling a $10 wide short put vertical, sell the 200 strike put out of the money by about $8 to the downside, and then to make it risk defined, buy the 190 strike put. You're collecting a credit of roughly $250. That's what you can make on it, $2.50 or $250 per spread. Takes your break even down to 197.50 to the downside. That's about 5% below the current share price in there. So you have a little bit of a cushion before you start getting hurt on this. You've got $750 in risk, but that's all the way down below 190. Gives you a better probability of success, about a 60% probability that that break even will be out of the money at expiration, which is what you want. The idea here is sell a put spread. You hope the stock doesn't go back below that 200-day moving average, which, as I mentioned, hasn't been there for over a year and a half. And you just get to keep the credit. The idea is, hey, this expires worthless, and I get to keep that $250 credit. I'm collecting implied volatility levels going up because the stock has pulled up back. So you collect more option premium on verticals like this.
Okay. So a different approach.
Yeah.
But one that's got a good history behind it of gains. So pretty high probability trade, I would think, just looking at the chart.
Yeah.
All right, $250 to do it. How much was the other one?
You paid a debit of $380 on buying the straight in the money call on Carnival.
So two very different approaches.
Yeah.
All right. Interesting. Thanks, Tom, for the trades. Thanks, Ed Butowsky, for the inspiration to go on a cruise.